Good morning and welcome to another Market Matters video update. My name's Harry Watt and today we're joined by James Gerrish, our primary contributor. Thanks for coming in today, James.
Thanks, Harry.
Today we're going to start with volatility. Non-existent last year, really ticked up a notch this year. What are we seeing, what's playing out and what's your view on that?
Yeah, a couple of things sort of combined to see the market off in the last couple of weeks. So US-China trade tensions, not new news, but the market seems to have fixated itself on that in the last couple of weeks. And obviously rising US interest rates, again, not new news, but the pace of that acceleration has ticked up in the last couple of weeks. So those two things have probably combined to see the market down pretty sharply. In my mind, it's simply something that those two things are the straw that broke the camel's back. The market was too long; it needed to correct. It was too hot; it needed to have a pullback, and that's the way it's played out in the last little while. So, look, I don't think this is the start of something more sinister, but it's certainly been a pretty aggressive pullback in the last few weeks.
Industries globally, where are we seeing the US, the Aussie, the UK and European markets? What are we seeing there?
So European markets are obviously being hit by what's happening around Brexit. I think they look more bearish than say the Aussie market, for instance. I think the US market, from a relative standpoint, looks still overvalued. The Aussie market's come back to about fair value. I wrote about that on the weekend report this weekend. So if I focus on the Australian market, we've had this big decline. Normally when a big decline plays out where we see an aggressive bounce the following week, we haven't really seen that. So we've seen a more anemic bounce last week. So the same played out in the US where we've had an anemic bounce. So when that plays out, I think we typically get another leg lower. So in terms of the Russell 2000, which is the mid-cap market, which has sort of led this market decline over in the US, I think that goes another 5 to 7% lower. It's a reasonable call. I think we outperform here. I think probably 5,700 on the downside will see it in terms of our market, and that'll set up a really strong buying opportunity into the Christmas rally. Fund managers are still holding high proportions or high levels of cash. Caution is still pretty elevated out there, and market tops or major market tops don't generally play out when caution and cash are high. So yeah, that's the way I see it at the moment, Harry.
That's right. All right, on the local market, we got two big movers. Let's kick things off with resources. I know you spoke to Rocky a few weeks ago about them. What are we seeing there? What are we trying to do? What's our view?
Yeah, so buying weakness we've been writing about in terms of the resource play. I think from a bigger picture standpoint, resources do well in an inflationary environment. Resources do well in a late cycle environment. I think we're clearly in a late cycle environment in terms of the economic picture as well as the market picture. In terms of resources going into an inflationary environment, obviously rising prices are supportive of underlying commodities, and I think resources do well in an environment like that. So we're reasonably underweight resources at the moment. We're looking to buy weakness. I put out 5 stocks last week that we'd buy into further weakness. BHP, Western Areas and a few others. We've got Rio Tinto in the portfolio. We've got Newcrest, and we've got to a lesser degree Mineral Resources. So buying weakness is the key in terms of the resource stocks, and we'll go meaningfully overweight resources into further weakness in our platinum portfolio.
All right, so definitely keeping an eye on resources there. The bank's big topic of conversation over the last 12 months really. Royal Commission is almost behind us. Are we looking at the banks more now than ever?
The Royal Commission's behind us, but the impost will continue on into FY19 and beyond for the banks. So, I said before about the ASX 200 likely to outperform global indices going forward. I think that's the case simply because it's dominated by resources and dominated by banks. Resources, as I said, do well late in the cycle. Our banks have been massive underperformers globally because of two main reasons: Royal Commission, but also property prices. So the Royal Commission, it's now a known. So in the last couple of weeks, banks have quantified what the impost to the Royal Commission will be. It's about $5 billion if you think about the cost in FY18 and FY19. So that is now a known. It's a big number. It's certainly a bigger number than the market was anticipating going into the Royal Commission, but it's now a known. So look, to me, banks are staying the rally. The other thing around that is property prices. Auction clearance rates have been low, and that's hurting the banking stocks. But we had another low number on the weekend, but banks are trying to rally today. So look, I think banks are oversold. I think the worst has been seen in the banks, and ultimately, I think banks have seen the low point in the last little while. So, I think banks go up from here. I think the Australian market is a relative outperformer because of that buying in the banks and support from the resources.
All right, looking elsewhere in the financial sector, the diversified financials, the fund managers. We've got Genesis, they've been weak. We've also got Perpetual, it's been a bit soft on a FUM update. What are we thinking there? Do we stay long? Are we holding them for long term?
I mean, these are your leverage play on the market. So, to start with the sector perspective, so if I look at the diversified financials, the fund managers, they're trading at about 24% discount to their 5-year average. So, as a sector, they trade on 12.9 times, which is a massive discount to what they generally trade on. So everyone hates them basically right now. So there's 3 times since '99 they've been this cheap. So they are very much on the cheap side. You go in and buy fund managers when people hate them and when they're at such a discount to where they traditionally trade at, because they're such leveraged operations. So they get, when money starts to flow into them, they get a PE re-rate. They also get increasing FUM going into them, which is obviously positive for fees. And then they get an increase of the total FUM given the positive movement of the market. So look, these are really leverage plays on the market. So when the market bottoms, these things will be the things to buy. So, Perpetual's a value manager. Value managers have struggled in recent times. If you think of Magellan, that's a growth manager, as in they've got the highest proportion of their portfolio in overseas growth. Platinum, it's focused on Asia. And then Janus Henderson, which you made mention of, that we unfortunately hold in the portfolio. That's a big global fund manager that's been hurt by Brexit. Plus they've got a bit of everything. So, that's trading at a massive discount to where it should be, in my view. So it's cheap, but the market hates it. The market will turn at some point, and these fund managers will rally hard.
Yeah. All right, looking at the industrial space, you spoke at length about interest rates already. Is that going to be too much of an impost on the industrials, or are we looking in that space? Yeah,
some parts will be an impost and some won't be. So if you look at, higher interest rates are a negative for housing, for instance, or housing construction. So you look at James Hardie and Boral, for instance. They're 2 areas that have really struggled over in the US, and Boral is trading at really low multiples here in Australia. I don't think that theme will turn around anytime soon. Flight Centre is an industrial that's come out with a profit downgrade, or their guidance have missed expectations today, and the stock's getting hit pretty hard on the back of it. So there are pockets of them that we'll look at. Aristocrat Leisure is the industrial stock that we've got in the portfolio. We like it, believe it's got sustainable earnings growth going forward, US dollar tailwind, etc. So look, on a case-by-case basis, we'll certainly look at them. But so things like housing-related stocks, we won't be in.
Don't touch it. All right, retailers. We picked up Super Retail Group not long ago in the income portfolio. What are we thinking there? Is there still some value in the retail space? Yeah,
don't like the sector bigger picture, but like a few stocks within it that have been doing well. So Supercheap's been doing well, Nick Scali's been doing well. Even though the share price has been under pressure in the last little while, I still think that is a really compelling buy at these levels, Nick Scali. Bigger, you think of Harvey Norman. Harvey Norman sort of has a large property exposure. I think that'll struggle. It's only being supported right now because of its high franking balance and chance of sort of capital management going forward. So look, I think you've got to be really selective in that area. The market became too bearish for retailers about 6 months ago. Some of those retailers have now rallied, JB Hi-Fi, etc. But overall, don't like the sector, but we've got a few select stocks that will be there, but we're not going to be there for a long time in the retail space.
More the high-quality retailers that we're looking at.
High-quality, focused retailers that have got a catalyst to move. So, that's what we're picking up on.
All right, healthcare. We've gone a little bit long healthcare recently. We've had Healthscope for a month or so. Cochlear and CSL we picked up recently. Do we like the healthcare space, or is this another sort of select name, pick a few?
Yeah, I reckon we've had Healthscope a month too long, to be honest with you, Harry. We've got Ramsay in there as well. And the last couple we bought, the CSL and Cochlear, we bought those into the market decline, so they've dropped sort of 20-25% from their highs. I think we might be wrong in terms of Cochlear, and I'm in 2 minds around CSL. I say that simply because, Cochlear is on 38, 39 times earnings, which is well over and above what it trades historically. So we've been patient and bought that correction. It comes down to whether that correction will hold now or will go another leg down. Today it's been really weak. If you put Cochlear on a normal PE, or its 5-year average PE, it's worth about $160 a share, similar to CSL. So it's really the market's appetite for those sort of stocks that will dictate what the market PE, what the market is prepared to pay for it in terms of a PE perspective. So look, I think we're too overly exposed in the healthcare space right here, Harry. So look, I don't think the thematic, or I don't think the view that we took when we bought Cochlear is playing out. We thought it would bounce from here. It hasn't. So we're not going to give that too much more room to move. We might cut that position and then, you know, focus on CSL. Healthscope's now become too cheap, in my view, to trim it out of the portfolio now. And RAMS is trying to move higher. So look, it's an overall sector. We've made a sector call in the last couple of weeks, but I think at this stage we're going to trim it rather than add to it.
All right, you spoke briefly then about the high PE of Cochlear and CSL. The high growth area of the market in general has had a significant pullback. Are we looking at any names there? What are your thoughts?
Well, there's two sides to this high growth market. So, you know, you think about Cochlear and CSL that get thrown into that basket. They're really high quality companies that have been growing earnings for a long period of time. They've got sustainable earnings going forward. It's just the multiple that the market is paying for those earnings got a little bit rich. Then there's other sides of the spectrum where there's these, you know, tech stocks that are on, or, you know, these smaller tech stocks in Australia that are on, you know, 100 times earnings, 120 times earnings, where it's so much blue sky already built in. It just takes a slight change of market's perception of paying for those earnings, or the multiple that they're prepared to pay for those earnings, or a little bit less positive news like we saw in sort of the money stocks, Afterpay, Money3, Zip Money, etc. at the back end of last week. A little bit of less positive news and money comes out of those very quickly. So I'm still cautious that area of the market. I think you can look overseas into this market decline and buy some higher quality, bigger tech stocks into this market decline. So that's where I'll be looking in terms of the high growth area if we see another leg lower in global markets.
All right, that's all for now. Thank you for joining us. Keep an eye out for the alerts and the reports. Thanks for joining us, James.
Thanks, Harry.